Hey, how you doing? I'm Ali Selby and welcome to Livewire's newest series, Views from the Top. Today, we're very lucky to be joined by Centennial Asset Management's Matthew Kidman. You know him quite well. He's going to be sharing why he's feeling so bullish today, as well as some of his favourite stocks. Thank you so much for joining us,
Hi, Ali.
Matthew. Really excited. Usually we work together in a more journalistic capacity, but it's interesting to be able to interview you today.
Yeah, well, you've got the hard job. I've just got to answer the questions.
I feel like your job's much harder than mine.
Okay, let's see how we go.
Yeah, let's get straight into it. In April this year, you shared a few reasons why you're feeling bullish on the outlook for equities. You obviously invest in small caps. They haven't done that well. Is that still the case?
Yeah, so earlier in the year, probably out the back of the end of 2022 calendar year, we had some good signs. One of them was share price action. So everyone loves to get dug into the fundamentals of the business and businesses, and you've got to do that, but never ever discount what the market's telling you. So what was happening last year? We kind of hit a bottom in October. Bond yields came off. That was October 22. Stocks started to rally. What was good about that? Sure, it was led by the big tech stocks in America around the globe, but at various times, other sectors, other stocks took the lead. And of course, at our end is the Russell 2000, much broader index, covers a lot more industries. Between July 23 and October 23, bond yields spiked again because growth was too strong, stocks came off. But now they've bounced again. So I reckon the trend's continuing. So, and the Russell 2000 is starting to lead again, and that big 7 tech, not so much. So we like that. The other thing was, once again, sitting with the technicals, the US going back that year had put in 2 positive quarters when everyone was ultra bearish. It was interesting. Normally when you have 2 positive quarters on the market, you tend not to fall back into a bear market. Okay, we had a weak quarter, but we think that trend is broken again. And the other thing, of course, is interest rates, which everyone talks about. We look like at last at the top of that interest rate cycle. And I always say, follow the rate cycle, not the economic cycle, because the rate cycle precedes the economic cycle.
Let's stick with that. You talked about rates being really important. Why is that?
Well, there's 2 fundamental reasons. The first one is that, of course, the 10-year bond, the US 10-year bond is probably the most important rate around the world for stock valuations, because everyone does a discount rate on future earnings. So if the rates come down, then you discount those future earnings less than you used to, so you get a number bigger today. That lifts PE multiples, it lifts earnings multiples in general. Typically also that bonds around the world follow the US in some form, it's the leader. So the Aussie 10-year bond might be lagging because our cycle's a bit later, but it will follow, so that's important. And the other thing about rates coming down is it helps things like interest bills, activity, lending in the community. That will come later. The initial one's the valuation, because it follows straight away when the bond yields. The other one feeds through into the economy. So very good for equities.
You talked about this a little bit before, but we've seen 10-year bond yields fall over the last month. What does that mean for markets?
Well, that's a good sign, because that July-October period in 23, when everyone got super bearish again, especially in small caps, the problem was the US economy was growing in that September quarter much quicker than anyone thought. Everyone thought a slowdown was on, and bang, we went again in terms of growth. It spiked. The bond yields, the bond market got it wrong. They sold off aggressively and the bond yields all went up a lot higher, markets fell. Now, we seem like that slowdown is on us now. So the economy is slowing down, yields have come off, inflation, which is the main bugbear, is trending down. Then you get the lower bond yields, that valuation's kicked in. What we haven't seen yet is 6-12 months down the track, the benefits of lower interest rates in the real economy. That's yet to come, and that's why we're bullish going out into the next year.
You just said there that economies around the world are slowing down,
Yep.
But you've also written before articles saying you don't predict there'll be a recession in Australia or the US.
Yep.
Why is that?
Well, the US, I don't think so. Australia, we've got to slow down on. We've seen the September quarter just happen, and it was very low growth. Some of that's to do with commodity prices that wax and wane, but it's slowed down. We'll probably get another soft quarter in December and probably March. That'll be the bottom, I think. Why don't I think we'll go into a recession? Now, a recession is 2 negative quarters, technically, but a recession, as we know it, unemployment spikes, there's a slowdown, that grinding. Why won't we get that? Because we haven't got excessive debt in the system. When economies hit the wall, it's normally triggered by rates going up, but it's when you've got excessive debt. Companies have got too much debt, individuals have got too much debt, and it unwinds when rates go up. people struggle to pay it, then they've got to pay down their debt. Now, there is some debt in the economy, but it mainly sits with the government these days. Individuals are in a pretty good position. We saved a lot over COVID. Company balance sheets are okay. We haven't got systematic debt through the system. So interest rates going up slow us down, but they don't necessarily mean that we have to shrink at a rapid rate when you have debt and you've got to reverse that debt.
As I mentioned in the intro, Centennial mostly plays within the small cap arena, but I know that you've been investing in some large cap names. Can you take us through that split between large caps and small caps in the portfolio today and why you've, I guess, made that decision?
Yeah, so we're probably on the way back to small caps now. Well, I know we are. And the reason is at Centennial, what we've got that a lot of other fund managers don't have the flexibility that we have. We can go to cash and we can go up the market cap scale to the bigger companies. And we deliberately do that. We think there's enormous value in being flexible because we like to protect the downside. So when 2022 was starting to unfold and the reserve banks around the world started to lift rates because inflation was no longer transitory, you had to hide somewhere. Small caps were going to be sold off for that reason. The bond yields were going up, valuations going down. So where do you want to go? Well, cash is a good position in that situation. We took on more cash, but big caps also more liquid, more resilient in that environment with higher rates, better businesses in terms of strength, not necessarily in growth. Hid in them. Come forward now where we think interest rates have peaked and we've still got some big caps, we're unwinding. We're going back into small caps. What you want to do now, if rates have peaked and are going to come down. Now in the US, I think they're definitely coming down, both at the short end where the Federal Reserve it controls it and the market. We're seeing the market come off. Australia's probably a little bit behind, but we're on the same trajectory, maybe 6 months behind. You follow the interest rate cycle. So you want leverage into a better economy 12 months down the track. Small caps is where you want to be. So we're slowly cycling out of those big caps that we hit in, that did quite well for us. We were up and we're going into small caps and we probably want more exposure. So the flexibility of the fund allowed us to be flat in 2022, in the year to June 2022, while small caps were down 20-odd%. Last year we were able to track the big cap market. Small caps had another bad year. They've had two. It's going to be different over the next 12 to 18. Small caps will probably outperform. And the key to that is what's our lead indicator besides interest rates? Look at the Russell 2000 in the US. We will follow it. It looks like it's coming off a bottom to me.
Other than the Russell 2000, are there any other signs that you're seeing that, I guess, investors have changed their tune on small caps?
There are a few. We're at a very early stage. You've got to remember at the back end of October, so we're in December now, it's only 6 weeks ago, the sentiment was horrible. Bond yields in the US and Australia were still spiking. And so we're very close to the turning point. So that means there's not a lot of signs yet, but there are some. There are some appearing, and a few of them are around capital raises. So we've had a drought in IPOs, we've had a drought in capital raisings, probably outside some very niche areas like resources. The general market hasn't. Now in the last 6-7 weeks, and anything that did raise money, it went straight below the issue price. And that turns everyone off. The market's not open. Just in the last 6 weeks, we've had some capital raisings that have worked really nicely. And so that gives me an indication. And the capital raisings, probably also the deadline of Christmas is approaching. People, if they do need to raise capital, need to get it out now. But they've responded quite well. And so I would think that the IPO market, which takes a longer lead time, you've got to get the prospectus ready and everything, there's probably a backlog. That probably comes, if the market holds in, after the reporting season in February. March, April, we will see some IPOs surface. And of course, there's talk about Chemist Warehouse listing, which is a backdoor listing, but kind of an IPO. That kind of stuff is starting to emerge.
If we do see a bounce going into 2024 or even early next year or some point in 2024, which sectors do you feel like could outperform?
Yeah, so I'm talking about a cyclical upturn. So I'm a believer that at the moment we're going through the trough. Rates are peaking, coming down. So in the market, you've got to, what works better when rates, if this time next year rates are lower. Now I'm not an advocate of that the Federal Reserve in the US is going to cut rates in March, but I think by mid-year they'll be cutting rates because the inflation rate will be so much below the interest rate. So that's quite restrictive, but they'll start cutting. Australia probably a bit later, the cutting, the official rates, maybe September quarter, back end of the year. So what works better with lower rates in a year's time is cyclical. So you want to be back on the cycle. So what fits into that? I think Australia is probably this time next year is talking about a housing upturn, possibly a boom. We've got a very restrictive housing market. It's tight as a drum, but it's difficult for developers at the moment to make it work. They're not getting the margin. But I think that plays out over the goodness of time, and we know the demand's there. Rates lower, bang, we're away. And I think that could last a couple of years, a great uptick. That means anyone with building materials, property developers, and then people who sell into those kind of things, like some retailers, a Beacon Lighting, a Nick Scarley, those people should benefit because they sell into Adairs. If those businesses are fit and ready, they should take advantage of it. I also think there's some lenders. So we know the banks, but there's some non-bank lenders that fit into that. A Resimac, an AFG, those kind of businesses I think will do well in that period. So, and everything that else comes out of that. Even some tech businesses that have been struggling after that sell-off in 2022 probably find a bit of a market. So I think it'll be fairly broadly spread, but it'll be those cyclical businesses that require a stronger economy. And as I said, the market will go. 2025 is probably when we see it in the numbers a lot, like earnings ticking up quite measurably. But 2024, the market will go.
You gave us a few examples there. We're hoping for a few more.
Yeah.
Can you tell us a few tech names that you would be interested in the future, and also some buildings related stocks as well?
Yeah, so the building ones are interesting. That you're creeping up into the mid-cap area, but there's a selection. And a lot of them don't look, this is the other thing I should have mentioned before, they don't look cheap, but don't underestimate the leverage in the earnings. So something might be trading at a historical high end of its PE ratio, looks expensive, but if you can get an uptick in those businesses and they've all held their prices really well, then the earnings could ramp up a lot quicker than what you think, so they don't look that expensive. And Boral has done a great job. CSR, very leveraged to the uptick in the housing market. Even you can get down into smaller stocks like a Big River, but at the mid-cap, Reliance, who provide various gardening products, that's part of that housing. So some nice kind of reasonably liquid companies. Reece in Australia, even though they've got a global business, but they're probably going to do well out of the US. I still think at that bigger end, James Hardie can do quite well. It's US focused, but the US is probably going to run for a while because they've started the cycle. They're 6 months ahead, but it will last a while. So there's a whole range of companies that you've got to look through and try and find, and not be too scared on the price. This isn't a value-based start of a rally. It is an uptick in the economy. And people have got to get their minds around that, because we keep hearing, how can the market rally when it's trading on a high multiple? And by the way, I'm not talking about the really big end of town either. I'm not talking about the four majors. In the finance side, who lend the money for the housing market, a lot of the small guys, like I mentioned a few, they're trading at 1x book, which is about right. That's where you want to start. So they're pretty good value if they can get an uptick in their earnings, the top line, that it will grow. And a lot of them in this downturn that we're going through have cut costs. So the leverage on the upside is quite nice.
How about tech? How about within tech?
Oh yeah, you did mention tech. Tech's a little bit harder, and it's not so much to do with the economy. It's just businesses that might have been sold off because interest rates went higher and so on. So we like a little company called Rungy, RPM Global. The code's RUL. They provide software at all different levels to the mining sector. And I've got to say, I'm still not quite a bull on the mining sector, but what I am a bull on is mining extraction of minerals, because we know they want them. Valuations, I think, come a bit later when they're later in cycle. Even things like that are on the nose a bit at the moment, travel, which kicked out of COVID, and now everyone's going, well, travel's peaking. I think by late 24, 25, travel will be pretty strong again, because the economies will be starting to kick up.
Okay. Are those stocks that you are adding to the portfolio today, or they're stocks on your wish list?
Yeah, a bit of both. So timing, because we're small and we've got that flexibility, we can move around quite a bit. So some of them we've started to add already. Others, you can probably wait a little bit longer. The catalysts are a bit further out. So, for example, in that mortgage market, so mortgages are probably a little bit better than what people thought. The credit growth on the housing market just recently was up between 5 and 6%. Bottom of cycle's 3%. It always tends to grow. I don't know how, but it does. 3%, and it probably goes to 7 at boom time. So it's sitting in the middle of that. So we're not in a bad position. So how do we get leverage to that? So we look at a company like AFG, which it does do some of its own lending, but it's mainly a broker and Australia's biggest mortgage broker. It's leveraged to an uptick. If you get interest rates coming down, there's a wall of savings that Australians have used, and there's so many people looking for houses. So you can buy that now, I think, going out. Something like a Resimac, which is using its own book. It's struggling because the banks have been so competitive and they're up against the banks. I think as you go out and lending demand becomes better for residential mortgages, the banks will grow and won't be so focused on market share. So a Resimac, potentially, if they've got their business in a good space, can pick it up as 2024 comes on and the market improves. So it's a bit of both.
Okay, Level 18 is a long short fund.
Yeah.
What opportunities does shorting provide in a sideways or a down market?
Yep.
And can you please give us an example of a stock that you are shorting today?
Yeah, sure. So what we do with shorting is slightly different. As I said, we maintain flexibility. We think that adds value to us the whole time. So we would hope our average return over the last period, 10 years or so that we've been going, has been gross return of 15%. Our shorts will hopefully add maybe 1%. It's just an extra tool that we use. We don't use it as a hedge against our portfolio. We don't necessarily do pair trades. We look at individual companies and we do it sparingly. Shorting is a dangerous game. There are so many things that can go wrong. Everyone's against you. And any shorted stock that is shorted, and people move in groups. I don't know what they do. They use it for funding. They're all in the same stock. So we just pick on stocks that we think, one, can't get taken over, or probably don't, but two, have problems. And so we're looking for a 15 to 20% gain. So we do it sparingly in the last little bit, and I don't think it's a great time for shorting going ahead because I think markets will go up. So you want to be long. One, and we probably our biggest short through 23 was Qantas. We were long in 22, short in 23, and the story's well documented what's happened with Qantas. One now that we've added to recently is Bapcor. Bapcor is in an industry where it's supplying car parts effectively, both retail and wholesale, and that's been a strong area. And even though it's been strong, the business is not going so well. It's got a few cost issues. It's not executing properly. I'm not saying they won't get it right, but we're probably seeing the best in that industry in terms of the macro environment, and you've got someone not performing so well operationally. Now that could be fixed over the course of this year, but for the moment we've been adding to that short and it's been working for us. So very stock specific, not that broad macro environment of saying where you've got to look and so on. That's stock by stock.
Okay, last question for today, Matthew. What's something that you've learnt recently that you feel like you wouldn't have realised if it weren't for the position you're in today? What's your view from the top?
Yeah, so this is a great question, and it was probably what I spent 90% of my brain power when I saw the questions trying to answer, because it's not stock related that we talk about all day. So it's interesting. I've been lucky. I've been a journalist and then I've been a fund manager. Good combination. What I deal in is information effectively, whether it be financial, whether it be economic, whether it be even political, all those things that... So what I've learnt is that people are too easily convinced of a simple scenario. So that can apply to anything. It can be, and today it's been exacerbated by the fact that social media, people are influencers. They used to be restricted to media outlets and governed. Now someone become an influencer, and so people have got predispositions. They've got biases that they want to hear. Some people call it the echo chamber. So if we relate that back down to stocks, then you can't just listen to the first plausible story because that sounds logical. Invariably it doesn't. So you've got to make up your own mind. You've got to do the work. Talk to people who actually know. So if you go back to COVID, everyone said, well, this is going to happen once COVID, we shut down, big recession, we can't get out of this. Talk to the companies, they're saying, well, they're trading okay. We're trading okay. And then the government stimulus coming. You would have missed a big opportunity if you listened to the consensus, the easy explanation. And so that has followed through. And today, most people are still bearish. Even we've had this bounce in the market since October. You go and talk to the companies, they're saying, well, our cost base is okay, wages are coming down. That's the other thing we didn't mention with inflation. Wages probably peaked in 2023. Our negotiations for 24 are lower. The wages still going up at a slower rate. Those kind of things setting you up for the future. You've got to start making your own mind and making some brave decisions into the future, but do your own work. Don't listen to the first plausible argument. It rarely ever is true. It's just a simple one.
Okay,
That's what I've learned.
That. Yeah, I absolutely love that. I feel like that's definitely something that would have been inspired from your time in journalism as well.
Got to remain skeptical, but stay optimistic.
Thank you so much for your time today,
Thanks for having me.
Matthew. Awesome to have you here on Views from the Top. I hope you enjoyed that too. If you did, why not give it a like? Remember to subscribe to our YouTube channel. We're adding so much great content just like this every single week.